Namaskaram. In this lecture, we are going to do past examination question and answers on DTAA and related theory questions. Cosmos Limited, a company incorporated in Mauritius, has a branch office in Hyderabad open in April 2020. The Indian branch has filed a return of income for assessment year 21-22 disclosing income of 50 lakh. It paid tax at the rate applicable to a domestic company of 30%. So because they are Indian branch, they are saying we will take the 30% tax rate plus higher education cess of 4% on the as per the basic paragraph of 2 of article 24, that is non-discrimination clause. Do you remember non-discrimination clause? What was the non-discrimination clause that we have in DTAA? Whatever benefit that we are having to a domestic company, the similar benefit should be available to the foreign company, meaning thereby any provisions, please understand, any provision that you are having in income tax law which are less favorable to the foreign company as compared to domestic company, that provision will not be applicable. But there is a proviso to this particular clause that I have told you. Indian income tax law clearly states that, or any DTAA that we sign with foreign country clearly states that, please do not consider having a different tax rates for a foreign company and Indian company, or having a higher tax rate for a foreign company as compared to Indian company as a non-discrimination. Do not consider it as a non-discrimination. Please do not consider it as a discrimination, because we are providing proviso to the non-discrimination clause. Look at this. The Indian branch has paid 30% tax rate which is applicable to domestic company as per the DTAA between India and Mauritius, which reads as follows. What is the language? The taxation of a permanent establishment which is an enterprise with a contracting state, that is a foreign company, has the other contracting state, shall not be the less favorable levied in other state than the taxation levied on enterprise of that other state carrying on the same activities in the circumstances, meaning thereby domestic companies should not enjoy more benefit as compared to foreign entities, or foreign entities should not enjoy less benefit as compared to domestic entities. Simply non-discrimination clause. Okay, in simpler terms. However, AO has computed the tax of an Indian branch at applicable rate of 40% plus higher and education cess. Is the action of the AO is valid according to the law? Definitely yes, because tax, though there is a non-discrimination clause, higher rate of tax is not considered as a discrimination. Please see the presentation. Under section 90, the central government has entered into an agreement for avoidance of double taxation with the government of any other country outside India or a specified territory outside India, as the case may be. Then the relation to the assessee to whom such agreement applies, the provision of income tax shall apply to that extent they are more beneficial to the assessee. So obviously we have to give more benefit to the assessee. Thus, in view of paragraph 2 of article 24, it appears that the Indian branch of the Cosmos Limited incorporated in Mauritius is liable to tax at the rate of 30%, which is the lower than the tax rate applicable to the foreign company. So prima facie, yes, whatever argument foreign company is having is right, but however, explanation 1 to section 90 clarifies that the charge of tax in respect of the foreign company at a rate higher than the rate at which a domestic company chargeable shall not be regarded as a less favorable charge and levy of tax in respect of such foreign company. Very, very important paragraph, my dear friend. Okay. And therefore, in the view of explanation, the action of the AO levying 40% of the tax on the Indian branch of Cosmos Limited is definitely in accordance with the law and action is valid. Next question. Kalpesh Kumar, a resident individual, is a musician deriving 7,50,000 from a concert performed outside India. So this is a foreign income. Because he is a resident, even foreign income will be liable to tax in India, and because source is located outside India, in foreign country also it will be taxed. Tax of rupees 1 lakh rupees were deducted in that country where concert was performed. India does not have double taxation avoidance agreement with that country, and his income is in India amounting to rupees 30 lakh. So domestic income 30 lakh, foreign income 7.5 lakh, and India does not have DTAA. Therefore, section 91 conditions will become applicable. Compute the tax liability of Kalpesh Kumar for the assessment year 21-22. Assuming he has deposited 1 lakh in a PPF, so ATC deduction, and paid medical insurance in respect of his father, a resident in India, age 65 year, 52,000. 52,000 will not be available. Maximum 50,000 will be available under section 80D. Assume that he does not offer 115 BAC, meaning thereby basic slab rate you have to apply. Look at this. So Indian income 30 lakh, foreign income 7 lakh 50,000, GTA 37 lakh 50,000, deduction 1 lakh 50,000, and in 80D it is 50,000. So net taxable income is 35 lakh 50,000. Please compute tax on 35 lakh 50,000. So tax on 35 lakh 50,000 will be computed in this manner. So 35 lakh 50,000 minus 10 lakh, that is 25 lakh 50,000 into 30%, that is 7 lakh 65,000 plus 1,12,500 is equal to 8,77,500. This is the tax you have to compute by applying the basic slab 8,77,500. Add 4% health and education says 35,100 plus equal to 9,12,600. Divide by 35,50,000, sir, Indian tax rate. So the average rate of tax comes to 25.71. I hope you should not have any difficulty at least till this point, because I have not applied any international tax concept so far. International tax concepts comes now. DTAA plays the role now. According to section 91, because 7,50,000 was the tax in a foreign country and 7,50,000 is taxable in India also, we have to compute the average rate of tax of foreign country. 1 lakh divided by 7,50,000 into 100. So it is 13.33333. Whichever is lower is the rate which will be available for double taxation relief, and doubly tax income is 7,50,000. So 7,50,000 into whichever is lower rate, that will be the relief computed under this law, and that amount comes to 1 lakh rupees again. So 1 lakh rupees will be subtracted and ultimately he has to pay 8,12,600. Now my dear friend, please understand, we usually add cess at the end, but in case of DTAA, we have already added the cess and then at the last stage we are computing DTAA relief. This is one of the common doubt student will ask me on batch. So why are you adding cess first and then relief? This is the pattern that we have to follow. Okay, we are computing the total tax applicable in India. One more point of observation, if they provide you TDS data, TCS data, advanced tax data, that data you should ignore here. Okay, that is the liability. This is the liability you are computing. Yeah, from the payable amount you can deduct the TDS, TCS and advanced tax, but not from the liability amount. Okay. Then notes, you know that section 91 conditions we have to fulfill. So the assessor should be resident in India. The income should not be accrued in India. That means it should be accrued outside India. It should not be deemed to be accrued in India. The question has been subjected to the tax to the foreign country and assessor has actually paid tax in a foreign country. And there is no DTAA agreement with the foreign country. In case all the conditions are satisfied, section 91 relief will be available. Next one. Next question. The following are the particulars of income earned by Miss Vivita, a resident Indian, age 25, for AY 21-22. Rupees in lakhs. Income from playing snooker matches in a country L. So foreign country, foreign income 12 lakh rupees. Tax paid in country L 1.8 lakh. You can determine the average rate of tax by dividing these two items. Income from playing snooker tournaments in India, Indian income taxable in India. Life insurance premium paid ATC, full amount will be allowable because 1.5 lakh is the limit. Medical insurance paid for her father, age 62 year, paid through credit card. We will assume he is a resident in India and we will give the deduction under section 80D, but maximum 50,000, not 0.54. Computer total income and tax liability for assessment year 21-22. There are no DTAA agreement between India and country L. Assume that she has not opted for 115 BAC. Again, almost similar question, very easy question. So first of all, let us compute her Indian tax. So 19,20,000 plus 12 lakh. So total income is 31,20,000. Then from GTI, we have to provide chapter 6A deduction. ATC 1,10,000. ATD 50,000. Okay, so total deduction gone. So net income is 29,60,000. On 29,60,000 we have to compute tax. 29,60,000 minus 10 lakh is equal to 19,60,000 into 30%, that comes to 5,88,000. 5,88,000 plus 1,12,500 is equal to 7,500,000. 7,500,000 is the income tax that is there. You please compute income tax. Then add health and education cess 28,020 rupees. That will be 7,28,520 divide by 29,60,000. That was my total income. So my average rate of tax will be 24.61. This is Indian average rate of tax. No DTAA effect so far. Now you have to compute average rate of tax of a foreign country. 1,80,000 divided by 12 lakh into 100. That is a 15%. Whichever is lower, that means it is a 15%. We have to apply this rate on a doubly tax income, and doubly tax income is 12 lakh rupees. So 12 lakh rupees multiplied by 15%, that is again 1,80,000. The net tax we have to pay is 5,48,520. Again, notes we have to write that she should be a resident of India. She should have income accrued outside India which is not deemed to be accrued in India. India should not have any DTAA with that particular country, and assessee is subject to pay tax in outside India. So all those conditions has to be